All right. Parag,
Hello.
awesome. Well, hey everyone, this is Sid, and I have Parag with me today, and we're talking about commercial loans.
Hey, Sid, how are you?
As good. Parag, as many people know, you are the SBA expert. And for many people that don't know me, I'm the commercial loan expert. So today, Parag and I wanted to get together with our community and talk about basic formulas that are looked at in the commercial loan process and the underwriting process. So, Parag, before we begin, I wanted to have you do a brief intro, and then I'll do my brief intro, and then we'll go right into this topic for about a half hour discussion.
Awesome, great. Hey, thank you, Sid. Hello, everyone. Thank you for tuning in. My name is Parag Nevetia. I own a company called Easy Funding Solutions. My background comes from being in banking. I was a banker for 20 odd years in commercial as well as SBA lending. 7 years ago, I kind of decided to kind of pivot out of the banking world and get into consulting mode where I help people make their businesses bankable. Once you're bankable, financing happens, you get the right price when you sell. There's projection analysis, and there's so many other things that can happen only when you're bankable. So basically, Easy Funding Solutions is an SBA advisory, SBA business finance advisory consulting and advisory firm located out of New Jersey. And hey, Sid, you can go now. Thank you.
Awesome. Yeah. So for the people, just as FYI, Parag is doing a bit of traveling, and so his screen is off today. But he is joining us by audio, and so the discussion will still be quite amazing. So for myself, I have a brand called Network with Sid. I'm a professional networker, a best-selling author, and also I'm a commercial lender. And so I talk to people, and Parag, similar to Parag, I've been in the banking industry for too many years, and I speak with business owners talking about real estate financing, commercial lending, lines of credits, working capital, all sorts of other stuff. So, Parag, let's start the show. Today, we're going to be talking about commercial loans, basic formulas. So, where do you want to start, Parag? Do you want to start at the where once the client brings us a package, what we look at, or do you want to go straight into underwriting?
I think we want to talk about really just we're talking about ratios. Let's just kind of talk about the underwriting part, right? At the end of the day, we want to see if we want to look at the various ratios. So why don't you start with the ratios, and I'll kind of just chime in.
Yeah. So when we talk commercial loans, we're talking about businesses that are then buying real estate properties, that are buying assets, and they need a line of credit and products like that. But for this discussion today, I'm really going to be focusing in on owner occupied, which means that a business is buying their building or whatever it is they're buying. And Parag, I think for the SBA world, that's the only type of product that's offered. There's no investment product, correct?
100% correct. SBA lending is all about owner occupied properties only, folks. So absolutely, Sid, agree with you 100%.
Cool. So for the audience, the first thing I look at is EBITDA. EBITDA is a simple formula. It's your earnings before interest, taxes, depreciation, and amortization, which earnings means your net profit, and then you add back interest, you add back taxes that have been paid in cash, you add back depreciation and amortization back into the formula. And that's actually the starting point. I tell most people understand what EBITDA is because a lot of people think revenues, think of gross profit, and then only think of net profit. And actually, in the banking world, a lot of people look at EBITDA as one of the key cash flow components. What's your take, Parag?
100% right. And if I could just add to that, in what I do with my, when I tell my clients or the audience, I like to tell them EBITDA is really the ability to pay back the loan. As Sid rightly pointed out, it's your net profit with your interest, your depreciation, your amortization, and taxes. What I would like to add is technically, and Sid, please correct me if I'm wrong, we don't add back the tax part of it. We add back basically the interest on any loans that will be refinanced through the subject loan, the new loan, and of course, soft expenses such as your amortization expenses, depreciation, and so we look at almost. Um, and there's a couple of ways to look at it. Some lenders look for EBIT, which is EBIT, excluding depreciation and amortization for the real cream in the cash flow, as opposed to the adding the depreciation and amortization as well, which is obviously an accounting methodology of adding, uh, you know, the adding. Help me with this.
Yep.
The term of the how they stretch the
It's a cash flow mechanism basically, because those are non-cash items, pretty much depreciation and amortization.
correct. So it's very important, but
yeah. So and one thing, Parag, the reason you brought up this tax thing, I've and Parag, you've worked at multiple banks in your past career, and I've worked at multiple banks. Some banks actually look at tax, but they look at the income tax paid by cash. It's usually in the cash flow statement, and there's on the bottom line interest paid by cash and income tax paid by cash. I've seen banks take that number out, so it just depends on bank to bank, really. But if what Parag was saying is pretty accurate, where most banks will see net profit and add back the interest expense from the prior year and the depreciation and amortization from the prior year, and that's how they come up with that type of formula.
Absolutely, and that's perfectly put. As far as EBITDA is concerned, and unfortunately, what does happen is for our business owner audience that we have, unfortunately, not many business owners really get an opportunity to talk about EBITDA with their CPA. Is what I found as a little bit of a problem out in the business community. I would encourage our listeners to have more conversation with their accountants, their CPAs, their CFOs about EBITDA, because that's ultimately, as Sid pointed out, the first thing that lenders look for is your ability to pay back the loan. Sid.
Yep. Completely agreed. And paying back the loan is priority number one. Every lender, doesn't matter if you think or not think, wants cash flow to be the top priority. So when I get a business owner that says that, hey, Sid, you know what? I have this great idea. I want to go buy this building. These are the things I'm looking at. I tell them straightforward. I said, how is this loan going to get paid off? Because if that conversation can't be had, then we can't even think about actually creating any type of a lending structure here.
100%. And I think what I'd like to also kind of pull out of this is sometimes people, like you rightly said, people get confused with, I'm doing $1 million in sales. I should be doing really well. Can I get a loan? Well, how about minus cost of goods sold? How your AGI, your annual gross income is great, but it's not EBITDA. It's not cash flow. So you minus out your operating expenses. Now you realize you got $5,000, but you need a cash flow of $40,000 in net profit. You got $5,000. Now we got to go backwards as bankers. You and I have to go backwards to see what kind of, to add back those little items from the tax returns to make it even more better looking, so that we know that ultimately the EBITDA is higher. You think? What do you think?
Exactly. And I don't want to go hound in on EBITDA, but ultimately for anyone that is starting a business, building a business, or matured in a business, if you can't understand what EBITDA is, then you're going to actually have genuinely a hard time understanding what the banker's thinking about, or the lender, whoever is you're thinking about, because that is like the structural ground, like a foundational ground in any loan. and all of our formulas are tied to it. And also the thought process and the underwriting on the commercial side and the SBA side tends to actually be tied to it.
100%. So
Cool.
we've talked about cash flow.
Yeah. So another thing I want to bring up is leverage, right? And leverage is more of it's an asset term, but it's also your equity term as well. It's your leverage is pretty much your liabilities in comparison to your equity, but it's focusing in on how leveraged you are as a business. And I know, Parag, sometimes in the SBA world, leverage is not as strong of a factor, but I could tell you in my business that leverage is an important factor across the board.
Absolutely right. And to kind of just piggyback on that, when we talk about leverage in the SBA world, we do look at the global debt service schedule and try and figure out how much debt does the business actually have, pre-existing debt that they have, and do they have the capacity or the capability of sustaining the existing debt as well as the new debt, which eventually increases the debt burden. So kind of going back to leverage, it is important for on the SBA side as well to really look at how much global debt the business has and add the new debt that they propose to kind of add into the global debt as well. So that from that standpoint, cash flow, kind of using that to sustain the leverage is what I'm trying to refer to.
Yes. Yeah. Now, for the people, that formula, at least from where I usually look at it, is your total liabilities against your equity position. And these are all just on your balance sheet. So if you want to say, hey, what's my leverage position looks like, you can go and just do it yourself. Go and pull up your financial statement and just figure out a time and point. Now, leverage changes. However, your maximum leverage should be, you could keep within what we usually look as a metric, under 4 times. So 4 times means your total liabilities against your equity should be no more than 4 times. However, for me personally, when I see anything closer to 3.5 times, 3.5 times, I tend to tell the customer, hey, start thinking about where you are, because in case this business explodes, you don't have enough equity, and it's going to take you so much more to liquidate your assets to pay your liabilities.
Which is very, very true. And I'm just kind of putting this in perspective on the SBA side as well. It's very important to talk about equity in any business, but looking at your leverage ratio, which is your liabilities divided by the equity, and not too many people, unfortunately, said, I don't know, this is my observation, but not too many accountants and business owners really talk about leverage. They don't talk about their liability divided by the actual equity, because I have seen that even equity, for that matter, is not spoken of very often.
Yes,
this is the reason
which is interesting, Parag, which is interesting because we're past now in this COVID period, right? And openly and honestly telling you, every single one of my deals, doesn't matter if my credit or underwriting department talks to me about it or not, but I look back at the great recession we had of 2008, and we were looking at equity. We were focusing in on equity because now the challenge is that if that business is not sustainable, right? Forget about income statement, forget about revenues and profits. If the business structurally, equity-wise, can't sustain itself, then this whole thing is going to just collapse.
100%. And that's the reason why we like to do why we've been doing these kind of segments on Facebook Live, to really educate our audience, basically to understand there are certain parts of the business that, hopefully through our educational videos, people can kind of pick on those and go back to their accountants and have some dialogue behind those, right? What do you think?
Totally. And It's really interesting because to segue past the leverage discussion, another thing that I wanted to bring up that a lot of people generally don't look at are some of those hidden margins. And what I mean by hidden margins is most people look at, I'm looking back at the income statement now, and they look at your year-over-year revenue growth margin, year-over-year revenue growth. They look at the gross profit and then the net profit. But one of the things that I actually tend to look at over the past, I noticed in the last 3 to 4 years, as the economy has a little bit of a shift, is the operating margin. And I actually go back to online and do some research to see, hey, is this company within an industry margin that fits? And there's a lot of data out there that can actually tell you if your industry, what your margins look like, and what you should be at based on your size, based on the human count, based on all these different things.
Very, very true. I tend to, on the SBA side, I tend to look at sales year to year for say 3 to 4 years. I look at every line item and put a column there for the percentage, because you've got to look at the margin. You've got to be cognizant of not just the numbers, but really the percentage of an increase or decrease on each line item, because at the end of the day, that's what lenders are really looking at. And the questions around that come back from the banker to the client are, how come I see that it increased, but the sales percentage was so much, but your AGI percentage was so much, or your net profit percentage, or even an expense item. So it's important to look at the margins. I'm glad you brought that up, because again, that's something that people don't really, the business entrepreneur doesn't really look at till they have to at the end of the year, when the CPA actually makes them look at it. But it's sometimes it's at that point.
And one margin, the term margin is just a general term for something against something. So in the income statement, a lot of the margin calculations are against your revenue number, right?
Correct.
And
Yes.
And then on the there's margins on different, you could look at it on the balance sheet side. There's margins there too, which people don't actually talk about. But what I found, and I absolutely love, is margins are a fantastic comparison over year. So you can figure out that, hey, my gross profit margin has been running steady at 70 to 73% over the last 7 to 10 years. And then this way you could create it into that type of a metric. But, these are things to just keep in mind, people, because a lot of folks never think of all these small little things when they're just thinking, okay, I just collect the data and give it to my loan officer and pray that the loan gets approved. And that's the most scariest thing. And that's why people like Parag are around. That's why people like myself. But more importantly, Parag is around to get businesses bankable, right? Because all those loans that get denied, Parag, we're working together right now on a transaction where, to be honest, if it takes it to another institution, it might not actually work. And so you're there, you're doing the number crunching, you're figuring out what the right structure is, and then you're going to take it to an institution and make things happen. So for the people, just as FYI, if you look on the bottom, Parag's contact information, his website, Easy Funding Solutions, is noted. Please, if you are in that kind of confusion point, SBA, non-SBA, just talk to Parag. Talk to me as well. You can reach back. You could reach me at hello@networkwithsid.com. But definitely, Parag, let's move. We got about another 10 or so minutes. Let's talk about DSCR. Okay, that is like another golden formula that I think every bank, every lender, everyone looks at. And if you're going to a real estate shop that's doing financing, or you're going to a big bank, or you're going to a small community, or you're going to Parag, they're all going to be talking about DSCR. And DSCR, Parag, let's talk about it. Why don't you give the definition?
Well, so it's DSCR is the debt service coverage ratio. It's basically how much debt do you need divided by what the debt is. Let's back up. It's how much cash flow you have to pay the debt divided by how much debt is required.
Yes. So
right.
I usually put it in formula perspectives: EBITDA divided by your P&I, and maybe call it your escrow payments if you want to include it in there.
Absolutely,
You know,
100%. So
so
it's your
yeah.
EBITDA.
So again, I'm gonna just say it one more time. It's EBITDA, 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 which we spoke about earlier in this video, divided by your principal and interest payments, and then if you want to drop in there, sometimes your escrow payments as well too for your property tax. But that right there formula, folks, that's like the golden formula for most of banking.
That's
I'd
your
say
home
all
run.
my career, you know.
Your home run is if you don't have the right debt service coverage ratio at the end of your financials. That's basically that's the deciding factor for the deal, right? Sid, what do you think?
Yep. Yeah, so most banks, and I've worked at close to 5 banks in my career, from the large money center banks to the small community banks. And there's a formula number called 1.25x. That's 1.25 times. That's the number that most folks are looking at for DSCR. That's the calculation. So what I mean by that is your EBITDA divided by your principal and interest. And principal interest doesn't just mean, by the way, your commercial loan debt, your real estate debt. That could also include your line of credit interest. That could include your equipment loan. That pretty much includes all your debt. But your EBITDA divided by your principal and interest, it should be 1.25 times. And what that ultimately means is how much cash flow you need to cover your debt.
And I'd like to throw this. This is a great conversation, Sid, and I'm glad you brought this up on today's segment. What I tell people also is it's for every $125 in expense, you need to have $100 in your pocket. It's as
Perfect.
simple as that. For $125 in expense, folks, you need to have $100 in your pocket. A bank, a lender, a financial institution wants you to have $25 more than the 100 that's required for the expense. And to add to this, on the SBA side, Sid, the SOP, the standard operating protocol for SBA regulations requires 1.1 times debt service coverage ratio, not 1.25. And this has changed about 2 years ago. The SOP was changed. This section of the SOP was changed 2 years ago. And while there are a lot of banks that keep saying 1.1 is all we require, I would just add, folks, be careful. There are lenders who will say, I don't really care what the SOP says. I want 1.25 times or more. And please keep in mind, in certain industries, that threshold can be higher. The riskier the industry, the higher the debt service requirement. It could be 1.3 times. If you look at larger financial institutions, most of them require 1.3 to 1.35 times debt service ratio, as opposed to community banks that may require 1.25. And if you look at SBA regulations, the book says 1.1. What is the number, guys? and that's something that, that's what Sid can help you with, your accountant can help you with, banker can help you with, and so can we.
That, Parag, what you brought up, that's why we're talking today, right? I mean, I'm a commercial guy. I don't have much SBA experience, but you're here. You know the rules, you know the data, you know the facts, and it's quite interesting that each kind of structure has its own purpose. And there are, like, if I talk about, and we're not talking about it too deeply in this conversation, but on the investment real estate side, the structure and the formulas are slightly different. So, for the people that are listening that want to reach out on the investment side, feel free to reach out to me and Parag both. We do have extensive experience in both commercial owner-occupied and investment space, but just reach out. I'm happy to help out.
Absolutely.
So Parag, of course, we got about 5 minutes. I don't want to go too deeply into something new topic, right? Let's talk about some fun things that are going on in the marketplace on the loan side that you're seeing, hearing, kind of give a market update and things like that. I thought the last 5 minutes would be reasonable to talk about that,
Yes, this is great. folks, basically on, and I speak for the SBA side, as Sid speaks for the commercial. So let me just point this out that right now, um, the sentiment on the SBA lenders is they want to lend to essential businesses. You know, in this COVID-19 phase, only essential businesses. So it's key to kind of define what an essential business is. And there's, if you go online, I think I did a webinar yesterday, and I forget, I can share that with you, Sid, and we can blast it out. Basically, there was a list of what they consider essential businesses, and therefore banks are willing to take a look at them. However, please keep this in mind. A lot of the banks have put their money out on the PPP program. So a lot of them who put their capital out already are at a stage where they're not able to lend out, which
Yes.
could be something that you will run into, folks, when you're going to to lenders to ask for money. Don't be surprised if they say that we're actually not going to be able to lend right now, and they might give you two or three reasons which banks have to give out. But do keep in mind that the other side of this is um, survival of the fittest. So you have the fitter banks that are still lending, but then you have the smaller banks where the capital has been used up already for PPP. So again, call somebody like Sid, somebody like myself, to have a conversation with maybe an SPDC in your area, SCORE in your area, small business, the SBA office, and any advisory firms that can help you with something like this to figure out who's lending. So that's basically my
Totally.
plan.
Totally. And look, people. So for the people, business owners, whoever it is that's listening, one thing that I'm going to bring into the conversation here is, from what I'm seeing, is a couple things. One, economically, of course, we're in this pandemic period. Lending is becoming an avenue that a lot of businesses are resorting to because, of course, they don't have the capital themselves because of things that are going on. But before you approach a bank, right, you please reach out to somebody like myself, like Parag, and just talk to us as to what exactly you need to go and approach a bank. And more importantly, if what you're thinking actually makes sense. Because I will be honest, I've worked at a very, very large money center bank. You could go check it out on my LinkedIn. I'm not going to mention it here. But they will tell you, oh, fill out this application, and then they'll just shoot it out to somewhere in, I don't know, southern part of the U.S., and then it gets declined, or you don't hear about it, and then you get a letter saying you've been declined, and you're like, what the heck just happened? You got to understand that this is not an economical time where it's just, oh, let me just throw stuff at the wall and let's see if it sticks, because you have those 10, 15, 20 employees that you have to take care of, and you have to keep the machine running. You may have to be paying electricity and so forth, and you cannot be sitting here just throwing stuff against the wall and going bank to bank to bank, because honestly, at some point you're going to get aggravated and you're going to say, this is not for me, and it can create so much more of a problem. So with that said, though, a couple of things I wanted to drop in there is, as a lender, a couple of things I'm looking at. I am looking at year over year numbers right now, which means is we're in August right now. I'm looking at July 31st of 2020, so January to July numbers versus January of last year to July of last year numbers, to get a sense of how much of a difference your business is. I am looking at that. And in the banking world, we call that interim financial statements. But talk to your lender and say, hey, look, this year has been a bit of a challenge because of the natural things that are going on. However, last year, look at my numbers, look at my productivity. Of course, this year we're going to see a lag, but 2021 is supposed to look much better because of these reasons. And I'm asking for that type of information because naturally I have to then go and talk to my credit department and underwriters and tell them what's going on. And the worst feeling is that, I get a package, the lending, the package is half of what I'm asking for, and the customer says, this is the most I'm going to give you. And I literally tell most of those people that you're just not the right customer for me. Because the thing is, this is a working relationship. I'm trying to get you that loan or whatever that is. Parag is trying to get you bankable and try to get that loan approved for you. So if you're not working with us, then the challenge is that you're not going to help your business out either. And this is like and Parag, tell me if I'm wrong, but I don't think so. That, we see this a lot, and this needs to be thought, because the struggle outside is totally different.
100% correct. If you're not bankable, financeable, approvable, then you're going to get a decline. There's no rocket science to this. This is not, so why go to a bank giving them half of what they need to see, because you're eventually going to be declined? Why not, call us, Sid, myself. We help you put the pieces together before the project goes into the underwriter's cubicle or the loan authority's desk, so that when they look at it, they're like, wow, this is great.
Yeah.
That is the point that I want to make.
Parag, I want to, and for the audience, just so you know, we're going to end this in about another minute or so, but please connect with us on Facebook, on LinkedIn, and then Instagram. Of course, both me and Parag, we're all over the world. You can just Google our names and you'll find us. But Parag, one thing is, I'm going to leave this off with, you and me are working on a transaction right now. And I'm going to be honest, Parag sent me the amount of work up front that he put into this project. And I brought it to my team leader. He reviewed it and immediately goes, we want to do this deal. There was not even let's restructure, let's do this. Parag did that homework. There's not much more I needed to do. And that's why we work very well together, Parag.
Sid, this is great. I love the feedback, and I appreciate you mentioning this. But listen, guys, at the end of the day, I was in Sid's seat. I was that lender for 20 years at 7 different banks. I know how banks want to see what they want to see. If you give us the opportunity, folks, to prepare you not to fail, that's what I'm asking. If we can prepare you not to fail, you will never get a decline. We will help you get to that point and then put you into the room full of banks, basically, to even have a conversation. But if you're not ready, like Sid said, you're not even, a banker is probably not even gonna, and you're gonna get a decline letter. You're not going to be able to have a meaningful conversation because your numbers are not lined up, your data is not lined up, your logic is not lined up. So if that's basically what, and Sid, thank you so much for bringing it up, because you're right. At the end of the day, my job is to wow a banker, because I was a banker myself, and I found a big gap in this space because people are not able to present themselves correctly. That's what we're about. Thank you. Yes.
No, I appreciate it. And look, I'm always going to compliment the people that know what they're doing. All right. My intention here is not to try to tell people to go find business for you or anything like that. It's because you know what you're doing. That's the reason why,
It's simple as that.
So, hey, listen, thank you so much, Parag. And you know what? I'd like to do this weekly, bi-monthly. We'll figure it out. But this is our 3rd episode. We have 2 other episodes on both me and Parag's YouTube channel. You can check out Network with Sid, or Parag has it on his, and Easy Funding Solutions on YouTube. And the data's there. We talked, our first episode was talking about the difference between a commercial loan and versus an SBA loan. Our second one, Parag, and was more on the financial data and what it requires to put a package together. And this one, of course, was really focused in on commercial loans and the formulas behind those loans. And so thank you so much, Parag. Thank you, audience members. And hopefully we'll hear some communication soon. Take care.
Absolutely.